You've got some interesting views on China versus the rest of emerging markets. How does that play out from here?
So for now, we prefer developed markets to emerging markets, and especially because of China weight. 2 years ago, if we were telling you that EM equities would outperform the S&P during a drawdown, I think no one would believe it. But it's clear that during this market sell-off from Feb to March, the resilience of the Chinese equities and Chinese renminbi was quite surprising. And I guess that if you want more beta in your portfolio, it makes sense to take more exposure into value, where you find in Eurozone and Japan, rather than Chinese equities, where it's more going to reflect a defensiveness position.
Yeah, and that does sort of fit with a view that you sort of have in the multi-asset portfolio over having a preference for those parts of the market that have been lagging from here. Just to sum up the conversation that we've been having for the whole hour, Sophie, why do you actually see more upside for equities for the rest of the year?
On the equity complex, I guess that we think it's going to be this mount up. So that's why we're still seeing the S&P at 3,500 by Q3 of this year, and with the convergence toward fair value, which is more around 3,300 by the end of the year. But from a relative perspective, like if you look at what's happening on the equity complex is that for now, there's two supported forces. First is the P expansion due to how much anticipation of the next economic cycle you could have. The other thing is the low interest rate that is boosting the bond proxy and long duration sectors and stocks. But it's clear that going like in the very short term, you want to gear to the equity markets where you have the more leeway in terms of monetary and fiscal support. And that's much more in developed markets at this point rather than emerging markets. So it's a tactical view we have here into value, but also where we see more support from the policy mix.